as everybody is filtering in. Again, those of you that are just joining us, please make yourself familiar with the chat feature. Let us know where you're coming from, what questions you have, or what we can spend more time on tonight during the presentation. Ken, you are welcome for organizing this. Actually, I cannot take any credit for this. How this webinar came to fruition is, I believe, either Jason or Olivia from Unbridled Wealth had a post on LinkedIn. It was interesting, and we started to have a conversation. It's like, well, if we're curious about this, you're probably curious about this as well. So, let's see, I am a QI for a 1031 exchange in Denver area. Some prospect clients and advisors are voicing concerns about security of funds and access to funds if FDIC insured were triggered. Any thoughts so far, Jason or Olivia, on any of these questions that people are dropping in?
Yeah, I think some of those we are definitely going to be tackling tonight, and talking about, FDIC topic and access to money topic, and acknowledging things like crypto and diversification ideas, and yeah, there's a whole host of opinions out there, right? Especially if you look through the news, and every station we go to is a different opinion, and every corner we go to is a different opinion, and that's the trouble with it. But
I think I have two opinions that are conflicting internally, so I'm not even sure what everybody else is facing. Yeah. Well, Jason, Olivia, thank you guys so much for joining us, and I want to thank you all for showing up on time and spending an hour's worth of your time with us. I think we have a pretty interesting topic to cover. Again, we'll be taking questions throughout the presentation in the chat feature. If you don't know where that is, poke around in the menu bar, and you should see a little conversation bubble. But if you have been around ICOR for any amount of time, you have met or come across the Unbridled Wealth team. Jason and Olivia have been wonderful in providing us information specifically for our beginner investor subgroup. So thank you for that if you've sat in on that. But Unbridled Wealth focuses on the infinite banking concept. And I wholeheartedly believe that every real estate investor should have that tool in their toolbox. And maybe you guys can chat a little bit about that towards the end. But Jason was living in Denver, is now in Indiana investing. Olivia, you have your short-term rental in Mexico. All of you, or both of you, are using your policies to do very interesting things. So with that in mind, you have a very special guest joining us tonight. Olivia, you want to introduce our special guest?
Absolutely. So I was joking that we had volunteered to do this webinar. I was actually talking to Troy. I'm like, hey, can we do this? Because this is something that Jason and I actually talk to our clients about every time we meet with someone. And we've been kind of like ringing the bell of like, pay attention, everyone. And then all of a sudden we're watching it happen. And so I kind of have a predisposition to signing up for things and then going to research a bunch so that I can then tell people what I learned. But this time we actually have a real expert with us, which is such an honor. Dr. Paul Mueller is a professor at, is it King's College in New York? And he's also, full disclosure, a client of Jason and I. And we've really just had a fun relationship, to be honest, of, serving him and his needs, but also learning from him, because he actually specializes in something called Austrian economics, which is kind of the foundation of everything that we do at Unbridled Wealth. And so having someone that is a real expert and very well aware of the situations and also the background and history on that. Paul's written several books regarding kind of the crash in 2008. And so he's well aware of things that are going on, but then also can speak to what should our concerns be and how can we protect ourselves. So our goal today is to kind of go over the history of how and why this has happened, why we shouldn't be surprised. Is it going to happen again? Probably. And it happens a lot more often than we actually hear about it in the news. So just because it doesn't hit CNN doesn't mean it isn't happening on a regular basis. And then what can you do to protect yourselves? And so that's kind of where we plan to land the plane tonight, is not just doom and gloom, but also kind of hope and some alternative options as well. So without further ado, I'm going to hand it over to Jason and Dr. Mueller.
All right. So yeah, we're excited. I love doing these webinars for people, and I love talking about this, and I love getting off script and just kind of diving into the nuances of things. So we're gonna pack about 3 hours worth of content in about 45 minutes, and so buckle up. We will take this from a very high level, try to drill down in some areas, but obviously there's only so much we can cover in this short of time. So by all means, please reach out to us and after the fact, and we can continue our conversation, off screen. Just a little disclaimer, we're going to get a lot of facts, but a lot of opinions as well. So any legal advice we're not giving, accounting advice we're not giving, just that little disclaimer. So what are we going to do tonight? We're going to talk about just understanding banks. What are banks doing? How's it work? Understanding what happened in the collapse, Silicon Valley Bank collapse, and then understanding economics a little bit, because that has to do with everything behind the scenes, right? It's not just the bank problem. And then understanding the alternatives. So we'll kind of drill through these, bounce back and forth. The three of us it'll be a lot of conversation points. If you have questions, feel free to put it in the chat. We'll pause a couple spots and let you ask questions as well, but we'll try to tackle the chat questions in chat as they come up if we can too. And we'll keep an eye out for them, try to tackle them as we go. So let's dive right in. Where do we put our money, right? There's lots of places we put our money, but the biggest and the point of the conversation tonight is banks, right? We're putting our money in banks. And that's what we're taught to do from day one, right? Save up your money, put it in the bank, warehouse it in the bank. What do banks do with our money? Do we ever ask that question? Do we know? I didn't know until I got into this as a career. I'm like, well, I just put my money in the bank and they put it in the vault. And that's where it sits until I need it back. And the more I learned, in my study of economics and money, and the more I found out, well, that's not really true. Paul, what all do banks do with our money?
Yeah, well, thanks for the invitation. Glad to be here tonight. I'm a grew up in Colorado, lived on the East Coast. I'm actually here in Leadville now, so I'm a Colorado resident. So excited to be involved with this group a little bit. So banks, especially what we have today, which is a fractional reserve banking system, are in economics what we call financial intermediaries. That is to say, they kind of sit between people who are putting money in the bank, like Jason was talking about, savings, and then they take a lot of that money and they invest it in various ways. So they lend money to people to buy houses, they lend money to businesses that are expanding. And what will be really important for our conversation tonight, understanding the bank run with SVB and some of the issues that banks face, is they also invest in various kinds of assets, and particularly they invest in various kinds of bonds. And so we'll talk about how their investment in bonds is triggering all kinds of problems given the rapid change in interest rates over the last year. One more quick thing I'll mention that I was thinking about as Jason was raising this, just something to keep in the back of your mind that we'll look at later, is banks face two issues that are related, but they're separate. So one issue is whether they're solvent or not, right? Are their assets worth more than their liabilities? Is their net worth in the bank? So that's a solvency issue, right? Are they in the black in terms of their net value? But the other issue that's become much more important and is really important in crises is liquidity. So maybe a bank is solvent, that is to say its assets on paper are worth more than its liabilities. But when people panic or are concerned and begin withdrawing money very, very quickly, the issue of liquidity comes into play, whether banks have enough money to give to depositors as they request the money back, and how do they raise more money if depositors continue withdrawing at a rapid pace like they did with SVB. So anyway, so banks are kind of this intermediary. They take deposits and they invest it in various ways, earn interest on it, and then sometimes will share a little bit, very small amounts of that interest with their customers. So we can talk about that more later, but that's basically what banks do.
Yep. So one of the big pieces is the fractional reserve banking system is this. So a long time ago, Fed made a rule, right? They said, hey, banks deposited money can be loaned out, to paraphrase, right? A portion of it. But as we hear it as depositors, we say, hey, we hear, but they're going to keep X amount on reserve. So the banks have to keep X amount on reserve. It used to be 12%. 1992, that 12% was reduced down to 10%. After COVID, in 2020, it was reduced. That 10% reserve requirement was reduced down to 0, and I think it's 0.03%. Something tiny. And so now what happens is banks can loan out basically everything that gets deposited. They have the ability to. They need some liquidity, like Paul was referencing, but high level, different size banks have to keep different percentage reserves in there. But they dropped it down to 0 in 2020. But so I'm going to look, here's what I mean by the 10%. I'm going to use the 10% because I think they'll go back to that eventually, I hope. But what that looks like is, say 3 people have $1,000 a piece and they're going to go deposit that in the bank. Okay, so the $3,000 got deposited in the bank. Well, the bank then takes that and then they put 10% of it in reserve. So $300 get put into reserves, but then they can loan out 90% of it. So 2,700 of it gets loaned out to other people. Those people, they take that money and it goes back into the banking system. And then once it goes into the banking system, those banks then are going to keep 10% of it. And then they're going to loan out the rest. So now 2,400 of that got loaned out and 270 of it is in reserves. Then those guys go and they put that money that they took into the banking system. And now 2,430 got deposited into the banking system. But now you've got $8,260 that's been deposited, but only $813 in actual deposits. And so that's what's happening with banks in a big picture, right? When they don't have the money, right? Because it's not sitting there in the bank locked up in the vault. So how did we get here, right? Big picture, and Paul's going to chime in here too. But really, we could take this back to COVID era. You could take it before that, but the current issue with the banking collapse lately, COVID-19 created this low interest rate environment, and interest rates were so low, and then there was this influx of borrowing, right? How many of you didn't get a better rate during COVID, right? I mean, think of all the money that was going out, PPP loans, the EIDL loans in mass. The EIDL loans were huge. Okay, so all these loans, and then new businesses were trying to get started, and capital's getting raised, and so all of this extra money needs a place to be parked for a little while. So they're parking it in the banks until they need it, right? Especially like if you got an EIDL loan, which we did too for one of my businesses, we put it in the bank and then you pull from it as you need it. And so it sits there. And then
Jason, quick comment on that too. I mean, the other thing that's worth noticing in this is, where does that money come from? And this is all money created by the Federal Reserve. So what happened is you had massive stimulus spending bills under Trump and then under Biden. And to fund those large stimulus bills, trillions of dollars of spending on top of, the normal trillions of dollars the government spends, To fund that, the government had to issue bonds to borrow money. And to keep interest rates from rising, the Federal Reserve created a whole bunch of liquidity to buy a lot of those bonds. And they basically, it's a process called monetizing the debt, where large amounts of government debt are funded through the Federal Reserve buying bonds with newly created electronic money. And so the background of your story here is that you have this huge influx of new money into the economy, into the banking system that then multiplies as you talk about. And that's key to understanding why interest rates remained low, even as you have massive government spending, and then also how we entered this high inflationary situation in 2021 and 2022.
Yeah, absolutely. That's what's happening, right? Banks are putting their money in bonds, low interest rate bonds also, right? And then things start inverting and bond prices start declining, and so banks start taking heavy losses. And I like how one guy put it. He says, when interest rates are higher, a dollar today is better than a dollar tomorrow. So investors want cash flows. And when interest rates were low for a long time, suddenly become high, all the money that was rushing to the customers is suddenly cut off. And that's what started happening. So what if the banks run out of money? And this is where I love this, from a different movie. No audio, guys, for a lot of you, but you get the picture in Mary Poppins, right? That scene where she's like, give me back my money. And then the lady says, the bank's not giving him their money. Well, I'm getting my money. And she turns into the teller and she's like, give me my money. And then everybody starts rushing towards it to get their money. And just creates what is called the bank run, right? A run on the banks. And it was this funny scene. I was watching it with my kids last week and ran across that scene. I had totally forgotten about it. And yeah, it is likened to, we often relate to the It's a Wonderful Life, Katie, yes. And just the life insurance, not the life insurance, the banking scenes, right, that we see. And we've seen bank runs. When did the last bank run we're quite familiar with happen, right? If you were around in 2008, banks were locking their doors, right? But isn't my money insured? And that's a fun one. We started to find out even recently, if we forgot, FDIC insurance, hopefully now covers $250,000. Well, I pulled these numbers. I didn't have more recent ones, but from 2021, it's not that much different. They had 9.53 trillion in insured deposits, but they had 121 billion in the fund. They were 9.4 trillion uninsured. So there's way more money in there, but that's okay. In 2020, I think it was, no, what year? Oh, in the Obama administration, they brought on, well, they could borrow from the Treasury if they're short, and that's fine. Where does the Treasury get its money? Well, from the Federal Reserve. Where's the Federal Reserve get its money? And I kind of kid sometimes. Well, they just print it when they need it, and that's more or less true. It's a lot like a game that we're familiar with. In Monopoly, you read the rules. What if the bank runs out of money? It says, well, the bank never runs out of money, right? Banker can issue new money on ordinary slips of paper. And as one guy put it, he said, the Treasury is financing the Fed. The lender of last resort has its own lender of last resort. And that's exactly what's happening. I don't know, Paul, you want to chime in on any of that?
I mean, there's a lot that could be gone into in terms of the history of money and fiat money. And I mean, what really matters at the end of the day is how much money exists and how frequently it's being spent, and over time, what is affected by all this is the purchasing power of money, right? So the Fed has the ability to print money indefinitely, and then the consequence of that ultimately is a devaluation of the dollar and inflation, as we've seen. So it's an interesting, it's kind of a world of funny money where technically they can always print money, but the real question is, well, what does that mean for the value of money over time and the cost of things that we buy with it?
Right. I have a, if I can get to it fast enough, I keep as a reminder, if you've never seen one, if you don't know the story, look into it, of Zimbabwe's hyperinflation. And they went into this absurd hyperinflation. And so I bought this online. I don't know if we can see it with the tiny film, but this is a $100 trillion bill from Zimbabwe. And it was worth like a fifth of a penny when I got it, you know. And they were just burning this stuff for fire because it was no use to them. The inflation was so bad. And
I had friends there actually, and they said that if you spilled something, that you literally got money to clean it up instead of paper towels.
yeah. So inflation can really take its toll if not addressed, right? So here we are. Enter Silicon Valley Bank. Paul's going to kind of take us through this.
Yeah. So Silicon Valley Bank, a classic bank run, and in fact, probably the most extreme bank run we've ever seen. Here's the timeline of the share price for Silicon Valley Bank. It's trading for $293 a share at the beginning of the week or the week before. And then a week later, it's trading for zero. Shareholders have been wiped out. And what happens here is one thing that this shows is that regulators usually don't know what the heck is going on until after the fact. It's kind of a common occurrence. We might like to think otherwise, but regulators tend to be very, very behind the eight ball on a lot of this because there's nothing wrong on the regulatory framework. There's no fraud. Moody's, they have a good rating from Moody's. Moody's is starting to catch up and get ready to downgrade them, and that's part of what causes this run here. But basically, Peter Thiel and others in Silicon Valley begin to worry about the strength of Silicon Valley Bank following their announcement that they lost 1.6 or $1.8 billion on a bunch of bonds that they sold, and that they were going to try to raise more capital. And why I say this is a classic bank run and the most extreme bank run we've ever seen is the estimates are that in a 24-hour period from Thursday to Friday, $42 billion was withdrawn from the bank. All right, there's never been that kind of withdrawal from any bank in history. It's an incredible amount of money to be withdrawn that quickly. And part of the reason that was able to happen is because Silicon Valley Bank was a little bit unusual in some of the ways it was structured. So unlike, the Mary Poppins or Jimmy Stewart banks that have lots of retail depositors like us, a lot of us in our personal accounts generally don't have a whole lot of money over 250,000, like in our personal stuff. And so you have lots and lots of retail investors under that insured level. Like, to give you a sense, if it was retail investors trying to withdraw money to get to 42 billion, you need like 100,000 people have to be like withdrawing their money in that same 24-hour period. What was different about Silicon Valley Bank is like 90-ish% of their deposits were what we call wholesale or uninsured over that $250,000 mark. And so you had lots of business customers who had $2 million, $5 million, $20 million, $50 million there. And it's a small, kind of relatively small network of companies, investors, and so forth. And they panic and they begin withdrawing, closing out $50 million accounts, $40 million accounts. And it only takes, a couple of thousand of those before you get up to 42 billion. What's interesting about Silicon Valley Bank is they weren't unusually leveraged in a way. So before the run began, they had something like 16 or 17 billion dollars in cash and liquidity, which is about 10% of their balance sheet. So it's not like they were keeping 1%. It was sort of 10%, fairly liquid bank. But again, this massive drawdown just dwarfed what they had on hand. And so the liquidity issue, the question is, how do they raise that money that depositors want to buy? Again, some of you are probably familiar with this, but what they have to do is after they've given out all their cash, they have to raise more cash. And the way you do that is you have to start selling assets. And so what Silicon Valley Bank began doing was selling off their bonds. But as you know, if you need to sell something really, really quickly, whether in real estate or anything else, the way you sell things quickly is you discount the price. And so because of the run, not only did they have losses because of higher interest rates, they also took additional losses on selling these bonds because they were in a distressed situation. They had to sell billions of dollars of bonds at any price they could get. And so the run actually worsened some of their losses as they tried to raise money to meet depositor demands. And then ultimately regulators stepped in because they just couldn't, the longer this goes on, the more money the bank loses. And so they froze everything on that Friday, and then kind of over the weekend decided how to unwind it.
Yeah, it was fascinating to watch. I was flipping through the financial news and stuff, but back on Wednesday, start seeing an uptick in things. I saw this particular article about Wall Street. Top 4 banks took 55 billion hit on the 8th. Silvergate tanked, and then all of a sudden, just this domino. So it can happen. I mean, people don't see it coming.
Yeah. So this graphic here is just to kind of give you a sense of the size that we're talking about here. It's significant. So the largest failure in U.S. history was Washington Mutual, and there's different ways they value it: 188 billion to low 200s. Silicon Valley Bank is pretty similar in size, a little bit smaller. But what's interesting is that Signature Bank also failed, basically like in the same week. And so you add those together, and that's larger than the Washington Mutual failure. If you look down at the bottom of this graphic, you can see other bank failures, and the circle corresponds to their size. And so there's a huge amount of frequency of these bank failures in 2008, 2009, 2010, even in 2011, but they tend to be much smaller kinds of banks. So SVB and Signature failing are pretty large failures in terms of the amount of assets that are involved in them. And then, of course, maybe we'll talk about this later, but it's worth mentioning for those of you who haven't followed it or thinking about it, that Credit Suisse is no more, and that was like a top 20 world bank, with over $500 billion in assets that was sold for $2 or $3 billion, the other day. And anyway, so there's a lot of, as there's a lot of choppiness and a lot of concern about what's going on with banks, and particularly, I don't know if we want to go into this now, Jason, or if it comes up later. One of the main things we should discuss and that people are interested in is, well, what is the status of uninsured deposits when banks fail, right? And that's kind of a point of discussion right now. So one of the concerns with Silicon Valley Bank is once it failed, all the accounts with more than $250,000 in them were frozen, just completely frozen overnight. So if you're a company and you had $10 million in the bank on Friday, you were logging in and you couldn't access your money at all. And if this played out the way our current bankruptcy laws are set up, is that your $10 million deposit actually counts as a debt that the bank owes, or a liability the bank owes, and you have to get in line with all the other creditors of the bank to get paid as the bank is liquidated. And so there's this concern not only that your money is frozen, and not only that you might not get 100% of your money back, but that you might not have access to your money for weeks or months until bankruptcy plays out. And this, as you can imagine, could be extremely disruptive. You can't pay employees, you can't pay rent, you can't buy anything. I mean, you're dead in the water if you can't access, if all your money's at the bank and you can't access it. And not only that, if you are customers of some of these companies, you had problems. So my brother's involved and has a real estate short-term rental business, and they run, dozens or hundreds of payments through billpay.com. And kind of everything's automated. And he got an email that Sunday from BillPay saying, hey, we might not be able to process your payments this week. And that's kind of a big issue. He's like, where's my checkbook? Do I write checks? How do we do this? So the disruption potential was extremely large. And so what the federal government ended up doing is they stepped in and basically guaranteed these deposits. They tell my students the equivalent is you got this line of creditors who are waiting, and some people should get paid first and some people get paid later as the bank's assets are liquidated and cash is raised. Basically, the government kind of stepped in and pulled the uninsured depositors, say, hey, you step out of the line, you go to the front of the line, we're going to pay you all the money, right? You're going to jump the line. And as you can imagine, there are a lot of people who are not terribly happy about that, who were in front of them in line and now are behind them. But they were worried about this kind of freezing of funds and payment issues. And I was concerned about that too. I think there are better ways they could have done it, but the freezing of $100 or $120 billion of company cash would be extremely disruptive for the economy. So you don't want that to happen.
Shock to the system. What's happening on the bigger picture? We zoom out a little bit further from the banks. I think it's just it's a national problem, right? It's a debt perspective. If you have never gone to this website, go to usdebtclock.org, spend some time. It gives you live rolling numbers of US debt, and it is both fascinating and terrifying at the same time. And I love popping in there every few months. I'll grab snapshots. Like I took this one back in October just to show the different numbers where we sat back then. I kind of update it every couple months because it's constantly changing on me. And so you see total US credit card debt 1.1 trillion, student loan debt 1.7 trillion. You've got federal spending almost 6 trillion. You've got all kinds of numbers here. But then in February, I went back and I pulled another screenshot. So I wanted to kind of contrast the two and show you how fast money's going up, how fast the debt is going up. Okay, so context, US federal spending in 4 months went up 6 trillion. We're not going to get political here, but we went up 6 trillion. In 1980, for context of numbers, 525 billion was this number. It was 525 billion. By 2000, it was 1.7 trillion. Now 6 trillion. So it went up 20 billion, I beg your pardon, in 4 months. US federal budget deficit, which is defined as the difference between the total amount spent by Congress versus the revenue received by the IRS, up to 1.4 trillion. That's 300 billion in 4 months. In 1980, the number there was 40 billion. It didn't go up 40 billion in 1980. That was the total in 1980. 2000, it was 168 billion.
So if I could comment on some of the implications of this, some things to think about. One of the things you should consider is when you see that budget deficit number there, one way to think about it is that is potential kind of money creation in the economy, right? If that's new borrowing and the Fed is going to accommodate that borrowing, then they're going to be adding money into the economy if they're trying to keep interest rates at the same level. Because normally you step in, you have new demands for borrowing, that drives up interest rates. If the Fed doesn't want interest rates to rise, it'll just step in and add, basically buy bonds to keep the interest rate from rising. The other thing to be thinking about, and you've probably read about this in other contexts, is in a higher interest rate environment, which is where we are and where we're going, the federal government's not going to be able to borrow like this a whole lot longer. It's one thing to borrow $1 trillion or $2 trillion a year at 0.25% interest. It's a totally different thing to borrow $1 trillion or $2 trillion a year at 4.5% or 5% interest. And as federal debt rolls over, there's kind of this constant rolling over of federal debt. Some of the debt, bonds that were issued 5 years ago, 10 years ago are coming due today. And what they do instead of paying that back is they issue new debt, new bonds to pay back the old bonds. It's called rolling over the debt. But the issue now is that as they roll over the new debt, they have to pay the new interest rates. There's this new interest rate regime. And so the amount of interest that the government is paying on its overall national debt is rising. And the longer we have high interest rates, the more that average interest on the debt will rise. And because debt's such a huge number, 30 trillion, right? So every percentage change in the average percent that the federal government is paying on its debt every 1% change on that average corresponds to an additional $300 billion of interest a year, which even for the federal government is not chump change. So we're going to be interesting. Really, I tell my students, we're going to see some pretty choppy and dicey conversations in Washington over the next 18 to 24 months because the cost of borrowing is rising rapidly, and they're going to have to figure out how to deal with that, and nobody's going to be happy.
Yep.
I'm going to jump in here real fast too and just draw attention to the bottom right hand little corner right there. The liability per citizen. That has increased since I have started looking at this. That has increased $400,000 in the last 4 years. I'm pretty sure in the last 4 years because we've been watching it at Unbridled Wealth for a long time and I haven't checked in a while. That's terrifying. And if we think that like, oh, they can just fix this somehow, like the way to fix this, you guys, is to increase taxes. It has to. I'm going to put a link in the chat to a documentary called The Power of Zero. And it's the first time I've really seen mapped out why this problem right here is actually a personal problem. It's really easy because the numbers are so astronomical to kind of play the ostrich, if you will, just to put our heads in the sand and like pretend like it isn't happening, or if it is, it's not going to affect us, but we're actually in the middle of the storm ourselves. And if our head's down in the sand, we're going to drown. Like, so it's something that we actually need to be really awake and aware of. And then, and if it isn't necessarily like petitioning Congress to figure out like, hey, we got to solve this. What are you actually doing on an individual level to take care of yourself? Because the snowball impact of this, and again, I might be getting a little bit ahead of ourselves. And this is, again, something Jason and I talk about all the time, but you know, we're told this thing of like, defer your taxes until you're ready to retire, deferred retirement, like, oh, and you know what, you can take a tax deduction on that today. Folks, like there's a little bit of a joke, but taxes are more or less on sale. And because if we are ever going to fix this and not become another Zimbabwe, more or less, that's the only solution forward. So I'll put that documentary in the thing down below for your own future education and going down this rabbit hole. But continue, Jason. I just had to put that.
Yeah. I mean, that's a good point, though. I mean, we're showing federal numbers now, but here, this last number at the bottom is personal debt, U.S. personal debt. That is all debt, mortgages, cars, etc. Okay, in 4 months, 683 billion it has gone up. It's a fascinating amount of money. Okay, but here is what I found the most interesting. At the bottom, near the bottom of this, U.S. commercial bank revenue received from interest went up in that 4 months, 36.7 billion. Okay, U.S. commercial bank revenue paid on interest-bearing accounts, 7.5 billion in 4 months. Now, wait a minute, what's the difference? They made 29 billion. Does that make sense to you? So it went up 36. Interest-bearing accounts paid 7.5 billion, and they made almost 30 billion. And so what if we could be the bank, right? Wouldn't that be nice? But we're talking huge numbers here. And I want to give you context of like picturing money, okay? So if you could spend $1 per second, you would spend $86,400 in a day, $31.5 million in a year. How many years to spend $1 trillion? Because we've been talking in billions and trillions. How many years to spend $1 trillion? 31,709 years to spend $1 trillion at $1 a second. The U.S. total debt, 94 trillion. Just to put that number in context. It's a massive number.
Well, that number must include kind of unfunded liabilities because the issued debt is closer to 30 trillion.
Yes. Yeah, they're huge numbers. So the big question before we kind of pivot is what should we do about it? But before that, any commentary, Paul, Olivia, thoughts and predictions?
Yeah, well, I think that we're likely to see other, one way people describe the rapid interest rate increase that the Fed has done is things are going to start breaking because people didn't anticipate this kind of rapid run up in interest rates. They haven't kind of considered what the impact of that might be. And so SVB is one kind of unexpected break that's happening. Commercial real estate is another area that people are pretty concerned about. The other thing I'll say is that I think there's kind of two sort of things. I understand probably a lot of you are invested in real estate, as I am too. We have seen a massive bubble in real estate. If you look at the housing bubble pre-2008, you see measures of how much equity people have in houses rise roughly $8 trillion over the buildup of the bubble, and then the bubble pops, and that $8 trillion of additional equity that was created then goes away as housing prices come down, and that equity disappears. Since then, we've seen equity go up about $20 trillion in the housing market. That is to say, there's about $20 trillion more dollars of equity in the housing market than there was 10 to 12 years ago, which is multiples larger than the housing bubble run up pre-2008. And the only reason you can have that is because you have an artificially low interest rate environment, which makes it very cheap to borrow, which allows people to spend and borrow more on houses, which bids up prices. And in addition to that, as we talked about earlier, you also have floodgates of money opened up into the economy during COVID. And so there's kind of two possibilities that I see here. One is that housing prices come back down significantly, and they're already heading in that direction. The other possibility is that we see inflation being here to stay for the foreseeable future. And eventually what's going to happen is that inflation rises is basically you have this inflated real estate values until money is devalued. And so even if real estate prices stay relatively flat, eventually the price level is going to catch up to it. And this is also the other possibility. So Olivia talked about higher taxes in the future. That's possible. The more likely outcome is that we inflate our way out of this, that we don't raise taxes because people don't like taxes, but instead we continue printing money. And what we see is taxes on currency as opposed to taxes to our bank account. So instead of writing checks, larger checks to Washington, D.C., what we'll find is that how much stuff we can buy with our money diminishes. And so one of the things to be aware of is that inflation is a tax, right? So if you have $100,000 and the federal government taxes you, let's say in income, and they tax you 10%, and you write a $10,000 check to Washington, that leaves you with $90,000 to spend. That is really no different than if you don't have to write a check to Washington, but prices rise 10%. You still have your $100,000. You haven't written any money to Washington, and yet your $100,000 buys what $90,000 would have bought. And so if you understand or look at it in that perspective, one thing that we've seen, and again, people haven't talked about this maybe as much as they should, is the largest tax hike in U.S. history over the last year. So in addition to property taxes and income taxes, everything else, we've all seen roughly a 10% tax across the board in the form of higher prices due to massive government stimulus spending that's accommodated by the Fed. And so something else to be thinking about is not just potentially higher tax rates, but whether inflation is going to continue to be higher than people anticipate and to erode the value of money. The technical term is seigniorage, a tax on currency. And that, I think, is the far more likely kind of outcome, because there's always going to be political opposition to raising tax rates. And there's also disincentives that are created by raising tax rates, something called the Laffer curve. So if you raise tax rates too high, people either don't report income or they stop working, or it's really not a good way to fix things, just raising taxes. So what's going to happen is you're going to have accommodative monetary policy for government deficit spending, and you're going to see the value of the currency diminish over time at a higher rate. I mean, it has been diminishing for a century. You're going to see it diminishing at a higher rate over the next 10 to 50 years would be kind of my main prediction.
Yep. So what do we do about our own finances? Right? That's the big question, right? Where are we putting our money? And Miss Olivia McGraw is going to take over here and kind of walk us through this.
It might actually, before we dive in, let's see if there's any other questions that folks have. I think it's a good kind of check-in point. I feel like we've addressed some of these questions, but feel free to pop it in the chat, or I think you can unmute and go ahead and ask.
Olivia, I'm not sure if you saw this question from Jay Peterson, but he asked, do you have similar opinion to Peter Schiff that this is the sequel to 2008 for banks? Why or why not? Major pullout of bank funds into higher earning accounts, such as money markets, which will affect bank liquidity.
Yeah, it's hard to say. It's hard to say. I think what people are trying to figure out right now is how large of losses do banks have that maybe we haven't taken into account. And then the other issue is the Federal Reserve's response to this. And this is part of the inflation point. I don't know if we want to go too far down this direction, but basically the Federal Reserve is stuck between a rock and a hard place right now. So they've been raising rates rapidly over the last year to try to cut back on credit flows, spending, reduce the amount of credit, and to slow the economy down to reduce inflation. And simultaneously, they've also been kind of slowly pulling money out of the economy by letting assets on their balance sheet roll off and not putting the money back into the banking system. That has been reversed. Over the last month or so, the Federal Reserve has lent about $300 billion back into the banking system directly to banks, both through their discount window and through this new program where they will lend banks money against the bonds we talked about earlier, only that they'll lend it against the face value of the bond, right? So, let's say you're Silicon Valley Bank, you bought this bond that in 2025 will be $1,000. And so in the low interest rate regime, you bought it for 960. And then in a high interest rate regime, it's now worth 860. So you've got the $100 loss. The Federal Reserve will lend you $1,000 against that bond. So they're lending money against the face value of these bonds upon maturity. So they are lending like crazy to the banks currently. And so even as they're trying to slow inflation, reduce spending, raise interest rates, pull money out of the economy, they've had to reverse that in a pretty direct way. And the question is, will that calm markets? Will that give banks enough liquidity to kind of weather the storm? It's hard to say at this point. But I would imagine we're in for more bad news going forward.
Thanks. Yeah. So again, like I said, this isn't all bad news bears. It's more to kind of raise awareness, we'll call it. So just looking to simply wrap this up a little bit with ways to serve and protect your money. So where can you warehouse your wealth? And when evaluating this, yes, there's money markets, yes, there's CDs, there's other things that you can do to and more or less diversify your investments. But I wanted to really look at more of the storage of money, which is typically what our bank accounts how they serve us. So liquidity and growth are the two main considerations that I was looking at. So the first one, just simply diversifying with multiple bank accounts. That's what a lot of folks do that are regularly looking at having more than 250,000 in. If this is a situation you're in, we should definitely have a conversation. One of the other guys on our team let us know about actually a service that will, on a daily basis, balance all of the multiple accounts to make sure you're staying below that FDIC insurance level of 250,000, which is a lot of money to be moving around to be thinking about. Number two, this is gold and silver, and I'm going to go deeper into each one of these, diversifying into gold and silver because it's liquid and it'll more or less retain a value. And then we had to throw in crypto there. This is kind of the wild card, I guess, but we'll put it in there anyway. And then finally, I'm going to dive a little bit into what Jason and I specialize in, which is cash value life insurance. And so again, tongue in cheek, this is not your grandparents' life insurance, because my grandfather sold life insurance. I can say that. This is a much different animal and creature. So we'll get into that in a few minutes. So first of all, multiple bank accounts. What are the pros and the cons? So pros, real simply, again, keep your balance less than 250,000 and you're insured. The pro of that is also that it's liquid. And so quick access to cash. And this is, again, more concern for like Silicon Valley Bank that was specializing as kind of a boutique bank for startup investors, for the Silicon Valley inventors, if you will, and startup companies. And so that liquidity is really important. So anyway, so that's multiple bank accounts keeps that cash flowing for you and readily accessible. And also just you have nothing new to learn in there. You know how to manage a bank account. You know how to manage more than one bank account. So that could be a pro. Cons, clunky. So rather than, you know, having everything all in one place, you're having to manage multiple accounts and keep tabs on that, which ideally, if you're at a level where that's a problem for you, you probably have other people that are managing this problem for you. But then also little to no growth. If it's in checking, you're going to earn nothing. If it's in savings, you'll earn a little bit more than nothing. And so is that really the best place as an individual to be warehousing your wealth? You know, just as Jason was pointing out, that banks are the ones that are making the money on our savings. And so ideally we're looking and working with clients to figure out how you can take over that function instead of making someone else rich off of your money. Oh, what was the last one? Sorry, I didn't see it. Go back. You can see who's driving the slides. Okay, to the cons. Come on, Jason, I didn't see the last one.
There we go.
Oh, there it is. Okay, still some risk. Yep. So should there be a run on the bank? Can it freeze? And will you be the last man in line or woman in line asking for that money? Absolutely. So if this is something that we think that this is the first of a series of freezes and bank failures, then yeah, your money's still going to be at risk no matter which bank it's in that regard. Well, yeah, anyway, we can go into more of that in a second. All right, next slide. So gold and silver. So my dad is a numismaticist. I think I said that right. So he doesn't just collect gold coins. He collects coins with a historical value, and those will retain their value above and beyond what the price of gold is. So if you're looking to actually invest in gold in a way, so that I'm not saying like go out and buy gold bars, but start to do some research and educate yourself on what is the best type. Just speaking purely for as the daughter of my dad, the coins that he has is investment coins that will retain his value and continue earning. And then he has the coins that he's willing to let go of. And those are called Krugerrands, R-A-N-D-S. It's the South African coin that by and large is the one he's willing to let go of and trade when my parents need some liquidity. So that's that. A lot of folks say, well, silver's a little bit more achievable. Silver is a lot more risky in Olivia's personal opinion, that those prices fluctuate a lot more. And so anyway, that's just kind of the harder one, but if that's all that you can go for, then it is a decent way to kind of diversify some of your assets, again, maintaining that liquidity and then a value for what you're getting as well. Don't stuff it in a mattress is also not on here, by the way, like we should say what you shouldn't do with your money. Cons of this, prices do fluctuate. And so depending on literally, you know, my sister and I like, Dad, could you just write down for us what you paid for us? So he's like, well, it doesn't matter what I pay for it. What matters is the value of when you trade it. I'm like, well, how can I know if that's a good thing or not if you don't tell me what you got it for? So prices do fluctuate. And so you've got to keep an eye on that. And some people log on every day and look at the prices of the stock market. My dad logs on and looks at the price of gold. So exchanging into cash, you need to know your numbers and you need to know where. He will literally drive down to Colorado Springs to exchange one of his coins because he knows he can get a better rate and has a relationship with a guy down there than he can here in Denver. And so it's just one of those things that he's keeping a pulse on and knowing where to go and what to do. I will throw in here, though, there is a risk of recall, which has happened. I don't know if it has happened in the last 50 years, But it has historically, Teddy Roosevelt recalled specific coins. And so that's always a risk that the government could say, we want all the gold, send us the gold. So that's also a potential. Now, do you have to turn it in? No, but anyway, you can't go trade your coins in exchange for cash. So next one, crypto again. This is our little wild card we'll throw out there. I think there's probably more cons than pros, but we'll roll with it. So it's outside the economic systems. It's technology based. If you're not aware of crypto and what it is and how it works, it has more to do with computers and cyberspace than it does actual tangible coins. But there's longer term potential. So is it liquid? Yeah, kinda, if it's a good day. But is it going to grow? Yeah, kinda, if you hold on to it a long time. So maybe bundle this one more into the stock market, I guess, category than liquidity. Cons, again, highly unpredictable, and a little bit clunkier to move around, not as liquid. And you need to know what type of crypto and where. I mean, if Elon Musk can tweet something about one of the crypto coins and people go buy it, then it's, again, that's kind of more of the influences rather than legitimate economic factors impacting the price and the value of what that currency is. And in my book, it's a little bit more of a gamble than it is kind of an investment and a great place to store your money. All right. So finally, we can't talk about this subject without actually discussing a little bit of what Jason and I do, which is infinite banking concept, IBC, cash value life insurance.
Can I interrupt you before you dive into that?
Yeah, please do.
I'm gonna make just a little plug for crypto. I've followed it a long time, and crypto. So it's a big area, and it is volatile. But I tend to be bullish on crypto in general because it provides an avenue to get out of the super debt cycle that all these countries around the world are going through. It offers an alternative to banking. It offers an alternative to holding your money in any particular currency. It's easier to move around than gold. It's less costly to warehouse than gold. Now, again, there's a lot of research you want to do going into crypto, but I think that it is definitely worth holding as a potential growth, speculative growth area. And it's the sort of thing you can take with you. You can literally, one of the most amazing things about crypto is if you know your key to access your crypto account, you can literally hop on an airplane, walk across the border, access your money from anywhere in the world. And so where we see crypto being most useful and adopted is actually in countries with oppressive regimes or high levels of inflation or massive banking problems. And again, just to kind of put a final point on that, to kind of show what this means, Bitcoin has jumped $4,000 to $6,000 per Bitcoin in the last 2 weeks, because you've got a lot of people saying, hey, maybe I should hold my money, some of my money, in a separate kind of place. So anyway, so I'm just going to, again, you want to do your own research, and there's a lot of kind of crypto stuff out there, but I tend, from a monetary perspective, tend to be fairly bullish on crypto.
And I think the highlight of it is people like it because it's decentralized, right? It's not just centrally controlled. And I think that's the big
thing. Yeah, so there is that, although this is important if you're going to invest in it, is that you have to be your own custodian. So people, as you probably read in the news, have gotten burned because they have other companies hold their crypto. They use exchanges, right? And so you had that big exchange in the fall collapse, FTX. So I'm talking about like being your own custodian, just like you would hold gold directly.
Yep.
Get a wallet. If you don't know what that means, but that's our biggest learn. Not we were in FTX, but similar, like it's actually like a hard drive. There you have your wallet and you have your money and you can take it with you. And it
takes 20 to 30 minutes of research and setting it up, and then it's pretty easy.
Yeah. Okay. So our last one, thank you, by the way, for rescuing crypto. So don't throw it all entirely under the bus. So cash value life insurance.
And sorry, just to interrupt you again. But I spend a lot of time with students, and there are a lot of young people involved in crypto. There's a lot going on. There's a lot of energy. So I've spent some time commenting on the monetary and theoretical side of it. And then I also, interact with a number of kind of practitioners about kind of what's going on. So it's, anyway, so I just wanted to offer that.
So ditch everything we said and go buy some Bitcoin. Just kidding. All right. Let's see here. Any suggestions on the best source for a wallet? Ooh, that would not be me to answer that. Okay, thanks, Latasha. She likes Exodus, so all right.
All right.
So
We'll let
go
Chad-
ahead, Jason. All right,
Yeah,
we've got a bunch of pros on this. So again, I'm going to go through each one of these a little bit because this is one of the reasons why we love it. And we decided to dedicate our careers to teaching people about infinite banking. Number one, it's very quickly liquid. We watch money transfer around quite a bit. If and when there is a stall in it, it's by and large the bank that is the holdup. Your personal bank when money's going back into your bank account. Two, guaranteed growth. So unlike your bank account that's going to credit you 0.02%, this money is literally going to have guaranteed growth and then also have compounding interest growth later. Transferable to any bank. So let's say your bank locks up and you need some quick cash. You can actually transfer from your policy and go to any other bank, a credit union, any other place, as long as it's in America. That is the one caveat. You can't cross the border and open one up, but you can stay within our country and open up another bank account and have money transferred there as long as your name is still on it. Or if it's a business, the business still has access to that cash. Let's see here. What else do we have? Flexible loan terms. So when you become the banker, you could pay interest only on a loan. And I've been in that boat where I've paid interest only. I didn't make any principal payments for over a year and a half. And you get to set up the terms of that loan as well. And again, this is more about learning banking concepts than it is just using this as a vehicle. It is life insurance at the end of the day. So there's life protection in the while you're learning how to set up banking. There's also long-term care protection. So a lot of these can function like long-term care insurance. So that's for critical, chronic, and terminal illnesses. And then literally your money is growing until you stop, until you die. Stop fit better than some of my other euphemisms. So the money is growing at compounding interest literally until the day you die, even though you are borrowing from the cash value and putting that money into work someplace else. So this is why, again, this is brilliant for real estate investors. And also your money is growing in more than one place. So that's the trick of it. It's growing inside of your infinite banking concept, and it's growing outside of it in your real estate investments or crypto if you want to, or anything else. And finally, there's tax advantages. All of this is very nuanced to the language of loans within the policy. We take out loans, not withdrawals, because no one pays taxes on loans. And so that's where you can become tax savvy, we'll call it. I'm not saying don't pay taxes. As you saw that debt issue, somebody needs to pay them. So, but I am saying to just be conscious and aware of how you are paying those taxes and protecting the majority of what you're trying to grow your money, especially headed towards retirement. Let's see here, the cons. And again, everyone else is welcome to chime in if you can think of some cons here. There's a learning curve. There's a learning curve to all of these, that in terms of going outside of just the liquidity of a bank account, you're going to need to do some research and learn. And therefore, it also requires some discipline as well, that this works best when you're willing to be more disciplined about your finances and not just trusting a financial advisor implicitly to manage your money for you. So also, compounding interest by nature is slow to start. So there is an initial cost to start, but literally the money starts taking off and growing until you graduate from Earth. So I think that's by and large the last of it. I have some kind of next steps you can take. What we do is help people discover where money's flowing away from them. And you can, we help find where the money is stored and locked up, and redirect the flow and the storage so that your money literally makes money for you for the rest of your life. So, Jason, do you want to pop in the Calendly link if you want? Oh, Jason, we can give him an applause. He set up a whole website just for you all. If you want to follow up and kind of dive into a little bit more, there's a link on there to Dr. Paul Mueller's website and his blog. There's links on there to kind of our bios and the ways to kind of set up to learn a little bit more if you want to. And Jason and I are happy. Again, this is what we thrive in. This is what we love to do, is teaching people kind of some exit strategies from we'll call it traditional financial wisdom. So any other questions?
Change
Yeah.
the way you think about your money and you'll change your life. And I really believe that. I think we're taught such traditional ways of thinking. And I love the real estate sector because it's a different way of thinking, right? The more you understand about real estate, the more you understand the need for cash flow, money moving, not just sitting there. And when you understand that, you start to understand this infinite banking concept and how it works. And how you can use that as a vehicle to sort of turbocharge your business strategies, be it real estate or whatever else. And like Olivia said, that's what we you breathe and sleep this stuff. And I was practicing it. Olivia was practicing it before we got into it as careers. I was doing it before I got into this as a career, and I loved it so much. I was like, man, I really got to teach people this. I was doing real estate. I got into real estate back in after the crash in 08. And I wish I knew about this back then. It'd be a different ball game now. It really would be. So I would encourage you, go to the site, schedule a meeting with us, reach out to us. We'd love to chat and just hear what you're up to and see how we can help you guys out. I'll leave it at that.
All right. Well, actually, I think I'm scheduled to have a one-on-one with both of you on Friday.
Yeah. Yay.
right.
Yay,
So-
Troy.
Well, thank you guys. Paul, thank you for joining us all the way up in Leadville. Hopefully we can meet you down at lower elevation sometime. But Olivia and Jason, thank you for this presentation.
You got muted, Troy.
Troy,
Troy.
you're muted.
Someone muted.
What happened there? Anyway, I just wanted to give a quick plug. If you would like to meet Olivia in person, next Wednesday, we are having the Real Estate Market Movers Happy Hour here in Denver from 5 p.m. until 9 p.m. Feel free to join us for some or all of it. We're looking forward to sort of having a community conversation about navigating these very interesting times, finding more deals, getting off the sidelines. We hope that you will join us for that. And again, Jason, Olivia, Paul, thank you guys so much. And we will see you guys next Wednesday.
Thanks, guys.
Thank you.